You may have heard of buy term and invest the difference. What does that mean for you today? You are listening to Wealth Talks, and this is John McFie. Today, I have with me Michelle McFie, who I get to call Mom. Welcome to the show, Mom.
Well, I'm glad to be here today, John. Thanks.
Yeah, so we're going to talk about buy term and invest the difference. This is an idea that was popularized by A.L. Williams beginning as early as the 1970s.
Well, can you tell us a little bit about A.L. Williams?
Certainly. He started promoting term insurance because, according to his experience, that people needed more insurance coverage than they could get with just whole life alone. So instead of buying a combination of whole life insurance and term insurance, he got to looking at it this way. He said, well, what about you just buy the term insurance? You go invest the difference in the market, and hopefully the market returns will be big enough that pretty soon, especially when you get to retirement, you won't need the insurance coverage anymore. So that's a big assumption that buy term and invest the difference is built upon, that you won't need the coverage when it gets expensive.
Well, I also heard another word, and that was hopefully.
Absolutely.
So hopefully the market returns would be better than what you could have earned otherwise.
Yeah, and that's a big if.
Yeah.
And the results there are totally dependent on your investment returns. So we really have two assumptions going here. One, that the market's going to do really well. And two, that you won't need the death benefit coverage when it gets so expensive that term insurance is just going to expire.
Okay, so we've got two assumptions here. Now what?
Two assumptions going. Now, this idea of buy term and invest the difference, that looked really good in the 1980s when the market returns were roaring along. But a lot of people that followed this strategy, it didn't pan out for them because there's really three things that A.L. Williams overlooked, and people still overlook when they're looking at the buy term invest the difference strategy. Number one, the market doesn't always go up.
Well, yes, market has ups and downs. So buy term invest the difference is really focused on the market just increasing.
Absolutely. It's totally dependent on it. And the timing in the market is such an important thing. For example, recently, the blog last week, there's a quote in there that Dad has in there. He says, since 1970, missing the 25 best trading days would have reduced the S&P 500 from 9.94% down to merely 5%.
Well,
that's a huge difference.
Yeah, and that wouldn't be bad if you knew which 25 days were going to be the best, but you don't.
Nobody knows.
And that's since 1970, so that's 25 days out of how many days?
Yeah,
a lot. Yeah.
Yeah, I don't know the exact number, but the whole idea is the market timing is the key here, and you don't know when that timing is happening. So how can you make that strategy work? And the bottom line is that we want to have a foundation of guarantees, and nowhere can we get that as good as we can with participating whole life insurance.
Well, that's right. And John, as you were saying, we can't know when those best days are going to happen in the market. I was just thinking about with a whole life insurance policy, we have guarantees all along the way. But if a life is lost anytime during that contract, there is a payout. We are guaranteed of that payout. And so that you don't have to pick your day.
Right.
It's just that when the day picks you, you're covered.
That's right.
And so that's a good thing besides even market returns.
Certainly. And term insurance can be a good thing too, because you can't necessarily get all the whole life insurance to equal the total coverage that you need, especially when you're young. That's where term insurance comes in. It does provide that coverage very cheaply, inexpensively, while you're young. You just know that part won't be permanent unless you're able to convert it later on.
That's right.
So one of the things that is helpful to look at as we're looking at buy term invest the difference versus whole life insurance is what is the rate of return that you would have to earn in the market to overcome the cost of your term insurance, just to match the value of what your whole life insurance will do day in and day out. And we've done a video on this example. You can find it in the resource links for this podcast. And if you assume reasonable management fees for the investment side, we usually see that the return, quote unquote, that you would have to earn in the market before fees, before taxes, in order to match the return that the whole life insurance is producing, we see anywhere from 6 to 9%.
Okay.
If you're looking at guarantees, that's going to be a little bit less, more maybe in the 4 to 5% return range. What you would have to earn in the market before fees, before taxes, in order to have left what the whole life insurance will provide in guarantees, or in some cases there plus the dividends.
And you just mentioned that quote a few minutes ago that of those 25 trading days, if you miss those, then your returns would only be 5%.
Mm-hmm.
So that's pretty interesting. The market is
right
really
in
not
line there.
returning that much more.
No, absolutely not. And so, does the market have the potential to produce that much more? Sure, if you're in at the right time, if you get the right investment in there, sure, it has the potential to. And that's when it comes down, when we're working with numbers of any sort, it's all about the numbers you choose. Because you could take that same example that I just provided, and you could make the investments look really nice by putting in different numbers, maybe a higher return, lower fees, lower taxes, and maybe those would be realistic in some cases. So the idea comes down to this here. We could argue about numbers till we're blue in the face. The numbers will work out sometimes, or they won't in other times. So the key here is that before we look at numbers, we really have to look at the philosophy that goes before the numbers. What's the strategy? Why are you doing it? What are you getting with the guarantees that you cannot get in the market?
Oh, very interesting. Very interesting to put that together. Because if, when you were just saying that, we could talk numbers till we're blue in the face and we could choose the strategies that always look good, I would say, I'll sign up for that, John. The ones that always look good. Yeah, put me down for that. But in reality, we don't get to make that choice. This is what, I'm going to do all the wonderful, because life is static. Things do happen. So if we can get as close to the guarantees as possible, then we've at least taken out one factor. We know what's going to be effective. And then what we do with those guaranteed values can bring, a chance for some extra profits on top of that.
Certainly. And, here's something that is good to consider as well here, because from the real cumulative returns on the S&P 500 from 1926 through 2017 were only 6.71%.
Wow.
So that puts us right down in the range where we're looking at with what the whole life insurance, the market equivalent rate of return before fees, before taxes would have to be. That puts us right in the range there.
Okay.
What we're looking at.
Interesting.
Now, when we're talking with clients, we often recommend a combination of whole life and convertible term insurance so that you can get the coverage you need today, and you can build the guarantees sustainably in whole life insurance over time, because it does take time to build those guarantees.
Oh, absolutely. You can't just, buy an asset and expect to have, unless, even think about when you buy a home or a piece of real estate. If you buy it outright, okay, then you own the equity in it. But if you're buying it over time, you're getting the benefits of living in that home, of being able to make changes as you want, or maybe if you're renting it out, you get the benefit of the positive cash flow after meeting your expenses. You get those benefits. But in order to have an asset that is just completely an asset with no liabilities with it, that takes time, or
sure does.
Lots of cash.
Lots of cash. I love that. Yes. So we've worked with a lot of amazing people over the years. Some of them have done very well in various investments, where they maybe did buy term and invest the difference. So maybe some of them have done very well. Some of those investments have done not so well.
Yeah.
And we always find out that as we're talking to these people, they wish they have some of the guarantees that come through the whole life insurance policies. If they would have started those years ago, or kept them in some cases. Some people, they came to a certain point, they cashed out their whole life insurance at a point maybe when cash was tight, or they thought they were going to get higher returns in the market. And now when we talk to them, they wish that they had kept a hold of those guarantees.
Right.
They realized that they could have been in a better place, had more options available where they are today.
Well, hindsight is always 20/20. So if we can go forward into making a decision with the hindsight that other people have, if we can kind of put on those glasses and look at that, it can really help us make better decisions.
Certainly. So with you talked to some callers a number of years ago who had bought term and invested in the difference. You want to tell us that story?
Yeah, so this lady called from, and I think we've told this story on the podcast before, and that's because this was a real life person that called our office and shed tears over the phone. So this woman called from the Gulf, the
Southeast.
Yeah, kind of the Gulf area of the U.S. And she said that she and her husband were agents with A.L. Williams Company, Prime America.
That was his big company back in the heyday of Buy Term, Invest the Difference.
Yeah, and they promoted Buy Term, Invest the Difference. They talked to all their customers, Buy Term, Invest the Difference. And she said, we bought term, and we really did invest the difference. And the reason she put emphasis on that is because she knows that a lot of people buy term, but really don't invest the difference. And so they don't have anything after all. But they bought term, invested the difference. They bought properties around those Gulf states, planning to have income from them. And then right about the time they wanted to retire, 2005, Katrina hit, and that huge storm came through, destroyed their properties. And so they rebuilt them up again, and they had them to the point that they were ready to sell because their family lived on the East Coast, and they wanted to move back to the East Coast to be with their family and, their children, grandchildren, all of that. It was time to go back home. So here they had got all their properties back up to value, not where they had originally been, but at least so they could sell and get out from under them. And then the Gulf oil spill.
Oh, yeah,
that crisis.
BP oil spill.
Yep, that crisis happened, and there they are with properties, again, that cannot be sold. And she was on the phone crying. She said, I wish I understood what you teach about whole life insurance, because we bought term. We really did invest the difference. We had those properties, but still they didn't work out. It went south, and now we live in a state we don't want to be living in. We want to move back to where our kids are, and we can't do that. And she was in tears, saying, is there anything you can do to help us? But they were also in a state where, their health was no longer good. Plus they just didn't have the cash flow to be able to start whole life policies. And, we tell that story because it was a real caller. Yeah. And, that's a message, again, we can put on their glasses and get their 20/20 from that experience.
Yeah, so learning from hindsight here. If we can put on their glasses here, something that is really key here, you hear people that are investing in the market, doing this buy term, invest the different strategy, they'll talk about diversification. So not all of your investments are going to be going after the high rates of return here. A lot of them are going to be hedged into, quote, safer investments with lower rate of return. So your whole investment portfolio is not going to be doing what the S&P 500 is all the time.
Right. Oh, and then you got to pick your 25 days, right?
Exactly. You still got to pick those 25 days. So the approach with using whole life insurance, we're not saying no investments, period.
Oh, no.
If you want to go find investments or have certain things that you want to invest in, either in your business or as a, quote, traditional investor, those opportunities should still be on the table for you. But, and here's the key, you want to get your guarantees as guaranteed as possible. What better place to get those guarantees and build a guaranteed foundation than with participating whole life insurance. And that's the point here.
Yeah, and John, I heard you almost like ask a question. Your voice didn't go up at the end, but you said, what better place than whole life insurance? And I'm just going to answer that question. We haven't found any other better place to get guaranteed the guaranteed growth that we get in whole life insurance. And we didn't start out being life insurance agents early on. That wasn't our first career. We changed to this career, or at least Tom and I did. We changed to this career because we see the value of whole life insurance. And so we're out there to teach people, show people, shed the light on this because we want people to understand the value in it. So we're not just, trying to pick something, buy term, invest the difference. We could sell a lot of insurance. No, that's not our plan here. We really want people to understand. We want you to understand the value that whole life insurance can bring to you, not only upon your death, but during your life. There's so many living benefits that you can benefit from.
That's right. You never want to float your guarantees in the market. Never want to give up guarantees for possibilities. There's a big difference between those terms. You don't never want to confuse those two. So here, more recently, instead of necessarily coming out with a straight buy term, invest the difference strategy, insurance companies come up with a hybrid product that's supposed to do it all for you. So, for example, you hear about the universal life insurance. That started up in the 80s when this buy term, invest the difference thing was going strong. And a lot of those policies came to grief in the late 90s and early 2000s because the interest rates of the 80s weren't around anymore. And so they came out with other variations of this universal life insurance, variable universal life that was tied to the stock market, and index universal life insurance that's tied to an index. They're really just variations of the same thing.
Yeah.
The same old buy term, that's the difference concept. It's a flawed concept to begin with, isn't it?
Yeah, it is.
Yeah. And so here recently, my brother Ben released a video. Has a set of children's donuts.
Okay, there's a story behind this.
Okay, go.
Okay, so a couple weeks ago, Ben comes to me and he said, Mom, do we still have those donut stackers? Ours has a white platform, a yellow post on it. It's plastic. And then these different colored donuts. The first one you put on is big, and then it's a little bit smaller. And you end up with either 5 or 6 donuts. Ours happens to have 5. And he goes, Mom, do we still have one of those donut stackers? And I thought a moment and I said, yeah, I think we do, because, I'm always anticipating maybe someone's going to come to our house with young children, and I want to have some toys that they'll enjoy. So I found it pretty quickly, and Ben goes, great. And off he went. And then the next day I turn around, and there in the office on his desk is a donut stacker. But he came up with this video, this really good example and a video. So you're going to tell us about that?
And that's right. And so the key is that these different donuts have to be stacked the right way to build your financial foundation. If they're not stacked the right way, what if you tried to stack all these donuts backwards?
Oh, you mean start with the little one?
Start with the little one,
and then
yeah,
because the little one,
the big one.
Yeah, the little one won't go all the way down to the bottom.
Certainly.
It only goes part way. And then you go to put the next donut on, and it sits on it. But then you go to put the next one, and there's no post there. And so they just kind of stack up then in the thin air.
Yeah, that's not very stable when you have market gyrations come along
and
rock the boat.
Ben did a video to demonstrate this. And are you going to put a link?
Yes, we'll put the link in the resources so you'll be able to go check that out. Because so many people, they try to build their investments first, and then they try to save. And you've heard us talk about this before. Then they try to protect everything that they built. But by then, it's often too late.
Yeah.
It's been destroyed along the way. And so the real way that you want to start this is you want to start with that foundation of protection. You want to build the guarantees on top of that. And then you'll be able to go out and take advantage of the different investment opportunities, the savings opportunities, even the opportunity to manage your own expenses or debts to recover cash flow that you would have paid to somebody else. That is a key. And if you build it in that order, your financial foundation will be so much more secure and stable than it can be in any other way.
Well, I just have to say, too, when babies play with those donut stackers, I mean, you know this from observation. When they first play with those donut stackers, they don't care what donut goes on first. They just put them on, and they might have one that goes partway down and then one that goes, not quite as far down. So they'll even have a gap between their donuts. They don't care. They just keep trying to put them on, and then they grab them and shake them off. And later on, as they become more experienced, they realize the proper way to stack the donuts, and they can get all through it. So when you want to when you're serious about wanting to put together a financial plan that's really going to work for you, you are going to want to follow the best model where you save, where you build liquidity, and then paying off debts, and then finally investing, not the other way around. Protecting and then saving have to come first.
Mm-hmm. Absolutely. So check out that video. That's a great video on the strategy behind managing your money. And then if you need term insurance or participating whole life insurance or a combination of the two, like we talked about today, give us a call, 702-660-7000. We'll be ready to help you. You are listening to Wealth Talks. Until next week, have a wonderful week.